Welcome back, investors, to Ticker Time News. I'm Adam, and today's trade was decidedly positive, building on yesterday's gains, though we are looking for follow-through to keep this rally effort alive. More on that follow-through and what to look for in just a moment. Now, today, the Nasdaq, the Dow Jones, and the S&P 500 were both, or not both, all three were up between 2.2% and 2.8% at this morning's high. But that's not where it stayed. The major indices took a sharp turn lower after the 10-year yield breached that 4%, that almighty 4% level on the 10-year. They recovered from session lows as selling eased up in the Treasury market, and the S&P 500 found support at that 3,700 level. The initial upside driver was partially fueled by better than expected earnings from Dow Component Goldman Sachs, which is one of your bigger investment firms out there. They were up 2.3% on the day. Plus, Johnson & Johnson had pretty good earnings news, ticker symbol J&J. But they did end up losing on the day 0.4%. So it was largely driven by a technically oriented rebound effort that spurred short covering activity and a fear of missing out. We've got to talk about FOMO after we've rallied for a few days, right? It's always in the conversation when there's a rally. Now, another big reason why today saw this big jump up is there was a Bank of America, the fund manager survey, and it showed something eye-popping. It showed the largest cash holdings at 6.3%. since April of 2001. So this also helped to fuel a contrarian traded rebound. Now, that survey, that's a big deal. That shows that even with this market, and this is the 15-minute time frame here on the chart in front of you of the SPX, and it's showing the past 4 sessions and how there's been these big explosive moves at the beginning of the day, minus the 4th session all the way to the left. But there's these big moves at the beginning of the day, and then it's kind of over. The market just chops around for the rest of the day, chewing up your capital, taking your capital away from you. It's almost like that's the job of the market right now, is to take the capital that you have worked hard to get and put it in someone else's pocket. The chop. That's what we need to be careful of as investors. Hey, Adam, trim some of my longs today. Actually, let's put this up so we can all see it. Here we go. Trim some of my longs today. My shorts getting killed this week. I'm hoping to get some profit from these before going long for the Santa Claus rally. Yeah, I do think there will be a Santa Claus rally. I think we'll definitely get a year-end rally of some sorts, whether it follows along with the path that we've been on so far this year when it comes to, I always pull this up, you guys are probably getting tired of seeing it, but the seasonality chart showing that mid to end November and then a rally into the remainder, or the close, I should say, of 2022. But it, even at the close here, it shows a loss of about 2.5% to 3% on the year for the S&P 500. So that's pretty substantial. But yeah, we've got to play around with this right here. This is what we've got to play around with. And that's why this market, I believe, is so choppy right now. Is anyone who is paying attention, especially to seasonality charts, they know that there's some funny business happening for the rest of this month. And we may not get a big drop down and a new low. I mean, this chart has been, and again, it's the red line that we're following. This chart's been spot on all year. And for it to suggest that we're going to get a new low for the year, it is possible that as I go back to the SPX for the S&P 500 and go to the daily view, could it have been that the low set on October the 12th, which was last Wednesday, could that actually be the new low for the year? Because if we count 3 lows or significant lows on the year, we have June as 1, September as 2, and then the one last week in October as the 3rd. So we've got that June, September, October low for the year, and then we had this big intraday low for October. So with the seasonality chart, maybe we're on the back half of the decline and potentially riding up higher, right? So I'm going to talk about some of what I see in this market here in just a moment. But I want to finish this thought here real quick on today. The stock market lost some momentum, and it hit session lows as the 10-year yield reached 4.06%. Let's pull up the 10-year and look at that. US one, oh, get my cursor right. US 10Y for the 10-year. And something else that we need to consider, the 10 and 2 being inverted, and I'll talk about that in just a second too. But look here, this thing has just been on a rocket ship up and to the right on the chart. It seems to have reached some sort of resistance here. This is the 10-year. So I'm going to throw this trend line up right here, okay? And that is exactly the resistance that the 10-year is running into, and it caps it at right about, what will we say this? 4.09%. That seems to be the lid that the 10-year can squeeze out right now. Who knows? Maybe another Fed rate hike could tip this and bring it higher. I would think so. And we're expecting that in just a few days on November the 2nd. And then another Fed rate hike in December. So the 10-year, while it seems to have found a limit for now, we've talked about the 10-year and its limits before, but as soon as the Fed hikes rates, man, it just goes back up. Now, looking at the 2-year, US 02Y for the 2-year, it reached 4.48%. And then stocks started to recover as selling abated in the Treasury market, and the 10-year yield ultimately settled right around 4%. Now, the 2-year, it settled right around 4.44%. You can see it's down ever so slightly in the aftermarket here. And we could also put a trend line to mark kind of a cap here for the 2-year right now. And that cap seems to be right around 4.55%. You know, 11 basis points, 12 basis points from where it settled today. So it's getting up there. It's getting close, but it is cooling off here in the after hours just a little bit. Now, this does leave the yield curve for the 10 and 2 at 44 basis points. That is a very steep yield curve. And you want to know where else there is a yield curve? It just happened today. The 3-month and the 10-year. Okay? This is a Fed staple. A Fed staple. The 3-month and 10-year. Today, it inverted. For the first time this year, the 3-month and 10-year inverted, and for the past couple of months, it's kind of been like flat as a pancake, neither one trying to give up any inverted area whatsoever. But today, it finally happened. The 3-month became 3 basis points higher than the 10-year yield. 10-year yield. This is important because this is a Fed staple. This is something that the Fed looks at to see if a recession is coming. The 10 and 2, us retail investors, yeah, we look at that as being inverted and saying, yeah, it's called prior recessions before, it'll do it again. But once that 3-month and 10-year inverts, that's when the Fed says, okay, we've got an inverted yield. There will be a recession, and it is coming soon. So this talk of a Q2 to Q3 2023 recession, like being hit hard, a real full-blown recession where unemployment rate is going up. Right now we have a paper recession where we've had 2 quarters in a row of negative GDP. Sure, that's a recession, but something feels off about it. Consumers are still spending a bit. We've seen that with the banks reporting. We've also seen that with some of the companies reporting. And we see it or feel it with the unemployment rate staying relatively flat, right? It's not really moving. When the employment rate starts to tick higher and we start to feel that squeeze, we've heard all the headlines of companies freezing on hiring or letting a few hundred here go, a few hundred there go, but we haven't seen big layoffs that will affect the job market. So that's why this paper recession of a technical recession feels a little off. It doesn't quite feel like a recession, and it's because the unemployment and spending components of that recession are missing, especially the unemployment. So by the middle of next year, I think that's when we'll have those two components screaming recession, and we won't be able to ignore it. All right. Looks like it's flagging too. It does have that appearance as well. The 10-year has that flagging look. Also, the 2-year has it as well, ever so slightly. So we've seen this before, right? Even here just on the 2-year, instead of going right back to that 10-year, you can see that flag pattern right here, and then it shot off a little higher. We're starting to get that right here again, although it's really, really soft. And here, not so much. This was more like an ascending triangle type pattern. But that's when it really sent it off higher for the 2-year. And the 10-year has those same characteristics right here that the 2-year has, as far as flagging and potentially going higher. And I think they will when the rates go up. Let's see here. Pull this next one up. I'm down about 10% on FAS. I'm sorry, FAZ. Let's pull that up here for you. FAZ. And can you please provide some non-financial advice? Oh, yeah, I sure will. All right. I said this, I can't remember which live stream ago, but it was last week, I believe it was. I'm looking to short banks. I've been looking for that. I haven't seen the opportunity yet, but I am looking to short banks. I think with the 3-month and 10-year inverting today, and something crazy about this is I don't see big headlines about the 3-month and 10-year inverting today, but it happened. Today was the day. For the first time in 2022, for the first time in years, we got the 3-month and 10-year inverted, and it's a Fed staple. I know I keep repeating myself on that, but that's how important it is. So with that, I am looking to definitely find an opening to short the financial sector, okay? Again, this thing, well, not again, I haven't mentioned it quite yet, but you can see that big 12% drop there last Thursday. That was heavy. So there is, and this is, so everyone knows, the direction financial bear 3x. So it's leveraged 3 times. That's why you have that 12% drop there. When the financial sector goes up, this goes down. When the financial sector goes down, this vehicle goes up. So it's a way to make some money here. And if we look here and we put this trend line on here, okay, we can line up these 3 marks, today's mark right there, and I'll change that because it's on the bottom to blue, okay? So it did come into some support today from that gap down. That's important, right? So we have it beginning on August the 16th. We have it catching as our second point on September 12th. And then today is our third point on that trend line. And for any trend line that you set, you need 3 contact points or more to validate that trend line. So we have it right there. This is a technical trend line. It is ascending here for this inverse look at the financials. So you being in the bear camp here for financials, it is good. I myself, I'm looking to get back in to short the financials. The volatility right now on the financials is pretty elevated because they are reporting their earnings. I think after the banks are done reporting earnings, I think you have a better chance of this actually dropping down. But this trend line support right here, right now, is something to pay attention to. So today's open, which would have been at 23.34, is right about where that trend line caught it today. Now, on the upper side, we don't really have anything that we can point to. There's almost like this megaphone type pattern that is just opening up as it goes. That's not really something to get excited about when you're trading. So I'll just take that one off of there. Now if we scroll in here, I'm going to go to the 15-minute view for this particular ETF right here, inverse ETF, and you can see as the financials have been gapping up in the mornings with the market, this has been gapping down. And it is mainly due to earnings reports right now. So I do believe that it's going to turn around. So that trend line support is very important. As I tighten up this on the 15-minute time frame, I'm just looking here. Just give me a moment here. I'm just trying to look at the bigger picture of how this thing has moved. I'm looking at the volume shelf profile to see where some pressure points might be. And it looks like we've got a pretty big air gap right here at about the 25.45, where it dips off on the volume shelf profile. And then it kind of pops back up. There's a couple of holes before it really shoots off. And then we're getting up to about 29.28. So we've got a little bit of a gap, especially, let me take this away, especially right here. Okay. So if the financials can catch a bid, break above yesterday's kind of high, then there's a real big gap on the volume shelf profile that would fill the gap made yesterday morning. Okay. And that, again, that comes in real close to that low there. All right. Let's bring this a little closer back in after I clean up these marks here real quick. And we'll bring it back in. Open it back up. Okay. So it bouncing off of that support this morning, that's a positive. Another positive is over the past 3 trading sessions, while it has been choppy, we go from inclining, right, to flat to a chop around session here. Actually heading lower if we put a straight line on that one. So this is all, at least to me, this is building right here to something. Okay. See, going from that high to that low, we're descending. The day before flat, day before ascending. So this descending here that we saw today, I think is a good thing. If we could find some support around this trend line right here, and and not cut through it, I think there's a good possibility that we could see a bounce off of that pretty strong and head back up, which would mean that XLF, the financial sector, would be heading down, right? Because this is an inverted ETF vehicle that you can use to short financials. So this is a good thing. It finding support along that trend line today to validate that trend line is a good thing. So no financial advice, of course, right? No financial advice. But that trend line there, that would be, in my book here, if you're down 10% on this, right? Let me go back to the daily view. Reloading along this trend line would make sense, right? We do have to watch. We don't want there to become a competition here with this trend line and, let's say, the 50-day moving average here, which really didn't interrupt trading for this today. The wick broke right through it, but it did settle below it. So I would like it to see it come up above that 50-day moving average. It's above the 200. That's looking good. So as long as it doesn't break this trend line, so tomorrow it's got to hold above, let's see, what would the lowest be here? For tomorrow, somewhere 23.54. If it could like hold that line and continue to build upon today, that would be a bonus. But remember, because financials are reporting right now, it will provide a lot of volatility as good and bad reports are fished out and that information is digested. So if you're shorting financials, this trend line is your friend, okay? So mark it on your chart. The beginning of it was August the 16th. You can line it up. It tagged it on September the 12th. And then today verified that trend line. So we want to see it hold above that trend line as momentum potentially builds here. Okay. So that's my non-financial advice for you. I guess I should also have the coffee mug. Don't sue me, bro. I should probably get that, right? Okay, so just real quick there, just on the technicals here. But I'm definitely looking to short financials. I think after earnings are over, with these higher yield inversions and with the 3-month and 10-year inverting today, that doesn't look good for the short or medium term for the financial sector. And that's a big weighted sector too for the SPX and the SPY. Now, going back to today, back to equities. They took their second leg lower in the afternoon. So if we go back and we look at the SPY, and I'm going to go to the 15-minute time frame here, and you'll see exactly what I'm talking about. This afternoon, right here, this drop right here. Why did this happen? What news broke this afternoon? It was all about Apple, right? Apple is a big directional driver in this market, especially for the SPY and the SPX. Apple plunged this afternoon, taking the indices with it. Now, one other thing to note here while I'm on the SPY before I jump to Apple is it was very positive to see it catch this right here. That was the 50-day moving average here on the 15-minute time frame, so it's not technically the 50-day, but catching that trend line was important to keep the momentum of this rally moving. The other thing too is today there was a lot of chop, right? There was a big drop this morning from a big move in the pre-market, and then we get to the cash market, and then we're selling off from that big bounce. It reminds me of the old selling in the strength, right? Yes, that's what it reminded me of. But it bounced around the purple line, which is, of course, the weekly expected move. So for the SPY, that's at 369. And it bounced around, chopped around that 369 level a lot today. So that's important. All right, let me go look at Apple, AAPL. And this is why, look at that big red candle. This is the 15-minute time frame for Apple. That big red candle right there, taking it back to being under its weekly expected move, which is at 143. That weekly expected move ended up being like the resistance at the end of the day. So interesting, right? Symmetry is important. So Apple, what was it, down or up, I should say, 0.9% on the day, but it plunged following news that it's going to lower its iPhone 14 Plus production. And that was according to an article, I believe, from The Information. That's the name of the online news source there. And the major indices, again, they recovered after the Apple news for some gains, but not a lot. The market did show some impressive resilience today, right? Let's clean this chart up here for Apple, and let's go hop in to the Qs as we're moving along here. So the market did show some resilience today. If you look at the Qs here, right? If we look at yesterday's high right here, that kind of acted as support for the Qs today, which is important if you want to see this rally continue. You want to see it build on each day. So taking out the prior day's high is important, not just gapping up in the pre-market, right? And then selling into strength as soon as the cash market opens. No, no, no. That's not what you want to see for a rally to continue. You want to see that after the market opens, that it builds upon that, and it builds upon the prior day's highs. And we at least caught a bid when we got down to that level for the Qs. So that is a positive. And then you can see that within the last 15 minutes of trading, it did pop back up above its weekly expected move, which is at 271. Now, maintaining a positive position is what I think the market did today, right? Those lows for the day kept up with yesterday's high. Now, today was a broad market rally. Let's go look at the sectors here. Pull those up. Look on the right-hand side of your screen here. All these green percentage points over there. It was a broad market rally effort, and it left all 11 S&P 500 sectors in positive territory. Industrials up 2.4%, held the top spot, thanks to earnings-driven gains in Lockheed Martin, ticker symbol LMT. They jumped 8.7%. Meanwhile, communication services, that is, communication services, they appear to have, am I looking at that right? Real close to pulling up the rear there. But I think healthcare may have been the actual bottom, but it was still up 0.5%. So everybody was in the green. That's good. Now, talking about some of this, let's look at SMH, which is the semiconductor index, because we do have some red on here. The Van Erik Semiconductor ETF, and this is still the 15-minute view, big gap up and then a huge sell-off into strength. And if we go back 2 sessions ago, same thing. Gap up in the morning, huge sell-off, and a sell-off throughout the day. Today, it was basically shop around. But once that sell-off took place this morning for semiconductors, man, it just couldn't really break above what held it down yesterday, which is a negative for semiconductors. And of course, we had a notable lagger in the semiconductor sector being Intel, right? Intel helped to drag the semiconductor sector down. It was down 2.1%, which felt the pinch of the reduced valuation of its IPO, and that is Mobileye, right? Intel is spinning off Mobileye as its own unit. The valuation for that dropped, which then hurt the valuation of the parent company, Intel. So that's why it dropped down today, pulling the semiconductor sector with it. You can also see there is some other red on here. KRE, which is your regional banking, basically flat, not too far down. You've got UUP, which is your bullish on the US dollar, basically flat today, but still in the red. Of course, DXY, which is the dollar, I'll pull that up. It was pretty much flat. Let's go to the daily view here for the dollar. Now, whenever the dollar has some strength, that puts pressure on equities. Now, I want you to notice the dollar here. I think the dollar is gearing up for another move higher, and that's going to put pressure on equities when it does so. The greater the rate of change, the greater the damage to equities. So the dollar today barely moved, 0.06%, barely moved. Closed at 111.99. It's at 111.95 if you round up. So that's the dollar. It had some weakness today. That helped. It had greater weakness yesterday, which helped the equity markets a little bit more. But I think it's just right here, right? When you have contraction, contraction leads to expansion, expansion leads to contraction. So now we have this right here forming on the dollar, and I believe for it to make another run up. My Sharpie keeps turning off for me when I'm not expecting it. When I want it to be on, it's off, and then it keeps turning off. Okay, well, I guess I can't use Sharpie. Can I sneak use you? No. Oh, well, I gave it a try. Anyways, you can see the formation there. I think it's getting ready to make a move up. Now, if you want to say the dollar has peaked, that's for you to figure out. But right now, what I see is I see the dollar making higher highs and higher lows. And until that is broken, until it's not making higher highs and higher lows, the dollar is still strong. So just keep that in mind. Okay. What else we have? We have the VIX. It went down to a 30.5, down 2.7% today. So those were some of the subsectors in the dollar there that were down. Now, if we go to energy, XLE, it was up a little bit today. And energy is an interesting sector. Okay. I'm going to talk a little bit about that here, but it's still right there within its weekly expected move. Past two sessions, it hasn't really moved all too much. Now, energy complex futures today, they did make a sizable downward move this session. WTI crude oil futures fell 3.8% to $82 a barrel. Now, I don't normally share publicly the weekly momentum information that I share with our private investor community. So take this as, what would the right word be to use here? Take this as a one-time deal. But energy and medical, energy stocks and medical stocks, They seem to have retained their relative strength this week. And they're in energy stocks and medical stocks are in our top 10 momentum stocks list this week. Now, the energy stocks, they're interesting because they continue to display relative strength. While crude oil, and to give you this comparison, let's look at U.S. oil, WTI crude. U.S. oil is the ticker that you would put into TradingView. There is a link in the description if you need an account. You can set it up for free. Here's oil. You can see it's off its highs, and it is technically now, I mean, if you want to really go at it, it's high up here for, when was that? The middle of June. This high to that high, that's lower highs. And then you could say that about the lows. Here's the low, here's a lower low, and here's a lower low. Now, this low here today, well, it needs to keep coming down so it undercuts that previous low to make a lower low. And then this would be intact. It would be on a descending mark there. But I don't think that's what's going to happen with oil. OPEC reducing production will increase the value of oil. Joe Biden today announcing that he's going to allow millions of barrels. I can't remember. It may have been 10 to 15 million barrels of oil to come out of the strategic reserve to help lower gas prices. I don't know if it's going to do very much, but Russia is in the midst of a war. The Saudis got a taste of some nice profits when oil was up over $100 a barrel. Both of those countries, number one, Russia needs the money, want the money. So why do you think oil prices are going to come down? Why would you think OPEC Plus is going to increase production to allow oil prices to come down? They're not. Two of the main countries want prices to be higher. One because it needs it, one because it wants it. It's being greedy. So OPEC Plus is just going to continue to try to pressure the price of oil to go up. Now, here's why I said I think this is interesting. The energy sector, right? Oil companies. Crude itself is down about 10% from its early October strength, its high. The assumption is energy companies like XLE, which is the ticker symbol for the energy sector, XOP or OIH, etc. You could go through a whole list of them. They will continue to produce good profits since oil is still very high on a historical basis. Traders should be cautious, though. This earnings season of what I would assume, and be careful, I do use the word assume there, of record high profits in these oil companies could be reported among this group, as the stock price could end up peaking on the headline numbers. Okay, here, let's use let's see here. Let me get my notebook out here. Let's see. Here's a good one that I would like to use. I always have a notebook with ticker symbols and, you know, percentage points and so forth. Oh, the screen there is going weird. Okay, of different companies that I'm always tracking and keeping an eye on, and I like to write notes. I don't know why, but I like to write notes. Not so much. I use the computer, you know, and to write notes, but I like in here too. Let's look at one here, for example. Let's look at ExxonMobil. Just to give you an example for my thoughts here. ExxonMobil, this is the daily view. It went for a big run up at the beginning of October, and it's kind of peaked here, right, on the daily. If we go like this, okay, oops, you moved on me, chart. Let's bring you up to there. Okay, need to change you to red because you're at the top. Okay, and we're going to put another one here on the bottom. Need to change you to blue. I should have done this in the opposite way. Right there, we could see a symmetrical triangle, right? So I think, well, I don't think, I know ExxonMobil has got relative strength, okay? And as their earnings are approaching, I think companies like ExxonMobil can continue to tick higher, all right? It was up 0.2% today, crossed that $100, stayed above $100 a barrel. I'm sorry, barrel, not talking about oil. $100 a share today. I think it can tick higher all the way up until its earnings, which are on October the 28th, right there where that vertical line is. However, once it reaches that earnings point, I think those headline numbers, record profits, could be the sell the news event. So I think energy companies, their stock can melt up until earnings, and then it will be a sell the news type of event for these companies. So that's why I think energy here and these oil companies are very interesting to me right now. Now, with the medical stocks, on the other hand, they've been attracting bids over the past few weeks as well, and even more so since the start of Q4. Healthcare, and that is XLV healthcare, it was up 0.6% today. It's in a downtrend, yeah, but it's been on a rally here recently, okay? Healthcare in general tends to perform pretty well on the back end of the year, especially in November for biotechs and pharmas. So we've got IBB, XBI, PPH, etc. Let's pull one of those up. Let's go IBB. Let's let that load. And you can always just do XLV if you're looking for just a whole approach. This is the iShares Biotech ETF. Now, if you want to find a leveraged one, Direction offers leveraged biotech ETFs. So you can use that if you would like to as well. So what I'm seeing here is overall, we're in a downtrend, okay? But on the short term of this, right, we could possibly go out like this, and we could potentially take the 20-day and come down, tag that. We don't have anything official here as far as trend lines. We've only got 2 touch points on both of those lines, but they are going in symmetrical triangle type of a shape here, which would mean that price is going to tighten and then break out. So keep an eye on pharma as well and biotechs, because they typically do good and could be the first to catch the year-end rally. So keep an eye on them. Okay, let's see. Where do we want to go here? Oh, yes. I must plug this since we were just talking about this. If you would like to get instant access to our weekly momentum stocks, our weekly expected moves, trade setups, top 10 stocks, and different categories like growth, value, dividend, etc., economic and market insights, and a private Discord server, all to help you gain the key knowledge to help you beat this crazy market. Just click the first link in the description. We'd love to see you there. Now, back to today's market. Let me pull the SPX up here, and we can look at that. And crypto, Bitcoin, and Ethereum, they are both holding like soldiers. They are holding the line, and I love seeing that. Now, the strength in the market will likely close the bearish gap from October the 7th, okay? So let's look at that. Let's blow this chart up here a little bit and look at where October the 7th is on the chart, okay? And remember, we talked yesterday or the day before about a potential 4150 run up on the SPX, about 415 on the SPY. So October the 7th, right? That was the island top gap down. So we have the island top right here, okay? We had the gap up and then the gap down. Now, today, could we be doing the same? Look at this. The gap up yesterday to today, right, is like this. Remember, back here on October the 3rd, we gapped up, and we're gapping up at right about the same price point, 36.77, 36.75. Both days are nearly identical. So are we going to gap up like we did today? And are we going to create another island top and then gap right back down? Is that what we're setting up? Or are we setting up something that's got a little more momentum? Okay, let's go back to this. That bearish gap there, it's been closed for the most part with our gap up today. So we're either creating something similar or we're going to have some real momentum behind us. Now, the S&P putting the October highs along the 3,800 level back in play with today's gap up, okay? So 3,800 was the top of this island topping pattern back here, okay? Right here. That's 3,800. That's the key level we would need to break for this momentum, for this rally to continue. If we get shot down again at 3,800, then maybe we're just in for another pattern that looks similar to that island topping pattern from October the 4th, 5th, and 6th. Now, last week's CPI data, okay, let's go back here. Let's bring this chart back down like this. Now, last week, September CPI data showed inflation still remaining hot and the likelihood of further rate hikes by the Fed. We're looking at 75 in November on November 2nd and another 75, maybe even 100 in December. However, from a technical perspective, one could make the argument that the recent 23% correction off the August rally high seen back here has already discounted that information. What I'm saying is this decline right here, maybe that already discounted inflation being high and more rate hikes to come. With the S&P 500 dropping back to that 3,500 mark, which was the 50% retracement of the pandemic rally, many, I'll put it in quotation marks, Contrarian investors are making the case for another relief rally to develop as earnings season gets underway. Last Thursday's reversal, the reversal rally, was a 5+% move from low to high. A strong gap down reversal that suggests sellers may have exhausted themselves after 2 months of a downtrend. Now, historically, mid-October tends to create a pivotal bottom for equities during specifically the midterm election year, right? And that's right here. We get the bottom. Let me get my drawing tool back open here. We get some sort of a bottom, and then we get a rally. Okay? Combined with extreme negative readings in both sentiment and breadth, the potential for a significant rally could be brewing, with the prospects of a temporary low now in place for the market. This is just one view of the seasonality chart that we hit that low already. Now, if we have a temporary low in place for the market, traders would be now shifting their focus to earnings season. Of course, nothing has changed on the macro view of things. So expect plenty of doubt from the, quote, talking heads on any progress in price action to the upside. As buyers take back control, look for short-term rally back to the 3,800, I'm thinking low here, the 3,800 to 3,900 zone. So back above this island top from October the 4th, 5th, and 6th, okay? If we could break that 3,800 to 3,900 zone, okay, that would be very positive for the indices and for the market at large. Now, if sellers do reload, concerns will rise if they press back below the September and Q3 low of 35.84. That's our low for 2022. So bottom line here, bulls just stole control away from bears. And they do have an opportunity to run prices higher. However, volatility still remains high. So one cannot just throw caution to the wind here. But it seems prudent for traders to roll back some of the bearish tones and focus more on the prospects of an upward grind from these levels until proven otherwise. So, what I'm saying is that what if we have already hit the bottom? That means we're in for a rally over the next couple of weeks. After the midterm elections, then we would be looking for the seasonality chart and a pullback before finally launching higher to close out the year. Okay? All right. Looking ahead at today's, not looking ahead, or let's look behind us. Looking at today's economic data, there wasn't too much, but there was some. Total industrial production increased 0.4% month over month. The expectation was a 0.1% increase. The capacity utilization rate increased to 80.3. The expectation was 79.9. The main thing to take away from this is that the output of consumer goods decreased 0.6% at an annual rate in the third quarter, much lower than the rate of change of 3.1% in the second quarter. Lastly, the October NAHB Housing Market Index. It came in at a hurtful, I would call the number, 38. The expectation was 44 after the prior reading last month of 46. The housing market is not looking very good right now. It's shaping up to be a tough winter for the housing market. Now, ahead of tomorrow's open, we've got Abbott Labs, Ally Financial, ASML, Citizens Financial Group, Procter & Gamble, Travelers, Winnebago. They all headline earnings reports. The economic data for tomorrow, market participants will get the following. 7 a.m., the weekly mortgage applications index. Prior reading was a negative 2%. After that whopping 4% in the 2 weeks ago of a decline in applications. And again, this is a forward-looking index. At 8:30 a.m., we get the September housing starts. The expectation is 1.46 million. The prior reading was 1.57 million. And the September building permits. And again, this one is forward-looking because you need the permit before you can start building the home. The expectation is 1.55 million. The prior reading was 1.51 million. Do you really think there's more this week than last week? I doubt it. But those are the numbers. Now, before I wrap up this live stream, because I've gone through my notes, now is a great time to ask any question you might have. And as you are doing that, if I could ask a quick favor of you, could you click that like button and share this video with a friend? Those two things greatly help out a small channel like this. And if you like the perspective and you want more, then consider joining our private investor community by clicking the first link in the description. You'll get instant access to our weekly momentum stocks, our weekly expected moves, our trade setups, top 10 stocks list, growth, value, and dividend, market and economic insights, private Discord server, even though there are some channels that are on the public-facing side with our Discord server, all to help you along your investor journey to gaining knowledge to become better at investing. We're all on that mission. All right. Do you think Tesla beats earnings? That's a great question. Let's go look at Tesla. Excuse me there. Got a cold going around the house here, so I think I might be in the beginning stages of it. I hope not. I hope not. Let's go look at Tesla. TSLA is the ticker. And let's talk about this. Tesla every week has a pretty big move set in place by the options market. Look at the spread here for this week. All right. I did update Tesla, didn't I? I'm pretty sure I did. Let me double check real quick. I think Tesla has been under some pressure lately. I think they can beat earnings. I do. Oh, actually, I have them. Oh, no, that's not right. Okay. Oh, what am I doing? Okay. Okay, so for Tesla, no. All right. Let's go ahead and do the weekly expected move here for Tesla and update it. Tesla has got a $20.91 move this week, priced in from the options market, but we're looking at a 225.90. 225 as the high and 184.08 as the low. So that right there is Tesla's weekly expected move. You can see today it gapped right out of that, but ended up coming back in to close below it. Now, this is a big gap here for Tesla in their earnings. Pulling their earnings up, I think they can beat their earnings estimates. I do think there is some margin pressure right now, but I do think they can beat. Now, where can this stock go? Think about this for a moment. The stock is on the higher end of the weekly expected move already, and it hasn't even gone through earnings day. So there's the potential there that investors have not priced in where earnings could be taking Tesla, which could be lower, right? It's below all of its key moving averages. It is below its 5-day EMA. It's not looking good. Technically, here on the chart, let's bring this back down so you can see those moving averages. They're all curling down. Tesla is one of the companies that was late to getting hit from the sell-off. And once it started, it started. Friday was a big one. But now that it's here, just under that weekly expected move, let me pull up something else here for Tesla. Just take a moment. So all right. Come on. Come on. It's taking a minute to load here. There we go. Come on. All right. It's loading. Okay. Let's see here. So for this, I'm just checking the numbers here. $1 for EPS. You could call it $1 and a penny for EPS. We're looking at 21.96 billion in revenue from one outlet, and TradingView 22.005 billion for revenue. Yeah. There's a lot of... So I think Tesla will beat its earnings. Like I said, I think its margins could be pressured. And that would show in this earnings. And those two things may combat each other as far as where the price could be headed. I mean, it's already on the upper end of its weekly expected move where it's sitting at right now. So it really doesn't give it itself that much room to move. And I do wonder here if I could get the implied volatility for tomorrow and where it could be headed, or at least what the risk range is for tomorrow. I'm letting it load real quick to see if I can quickly find that implied volatility. All right, come on. Unfortunately, on this live stream, things do take their time in loading. Next bull market, I'll get a proper setup. Okay, almost there. Come on, let's go. All right, let's go see here. Oh, this is just taking way too long. Oh, and then I get the unresponsive sign. That's not good. Come on, just want it to load. That's all I want. Oh, well, it was worth a shot. It was worth a shot. You feel like not many people are talking about the dollar when it comes to earnings. So Tesla sells a lot of vehicles overseas. I mean, they've got a gigafactory in China. With the dollar being elevated, that's going to hurt multinational companies. I'm not sure if that's the angle that you're coming with here. I feel like not many people are talking about the dollar when it comes to earnings. You are correct. Multinational companies, a strong dollar will put pressure on the company, and that pressure will show up in the form of margins, right? If their margin is being compressed, compacted, if their margin is shrinking, some of that can be due to the strong dollar. So the FX exchanges, I don't even know if they break that down within their earnings report or not. I don't know if Tesla breaks that down, but if they do, their currency expense will have gone up because of the strong dollar. But whatever the case, it will show up in their margin, okay? Their margin will be compressed. That's why I think Tesla could beat earnings, but their margins could be compressed. There's many different reasons for why that margin could be compressed. Currency and a strong dollar is one of them. Other reasons can be supply chain problems or any other expense rising within the company. Okay, so that's what I'd be looking for. Margin compression for Tesla. Even if they beat earnings, it's possible that their guidance completely destroys whatever potential gain Tesla could get from the beat on earnings. So I'll be curious to see what Elon Musk has to say about the economy and about what they are looking at going forward, because Elon Musk on Twitter has said we're going down the wrong path economically. So it will be interesting to see what Elon Musk has to say about where the company is headed, what they're projecting, and if he does talk about the economy one way or another. So that'll be interesting to see. I can't get the numbers right now. It's just not loading for me. Right now. I was hoping I could, but nope, I can't. I can for tomorrow for the SPX or the SPY. I can also for the TLT. So then that your question here, can you please check on JP Morgan and thoughts on TLT? TLT is a dog right now. It's not going anywhere, but it will, right? This is the time in the economic cycle where the TLT gets beaten down. What am I clicking on over here? I don't even know. Gotta get my cursor in the right place. TLT, let's pull that up. So we are in the last stage of our economic cycle, okay? And with the economic cycle in its last stage, stocks don't do well. Bonds don't do well. Then we go into stage one. Also, the last stage of the economic cycle and of the business cycle are contraction, right? Where we're done with growth and now we're going into the phase of contraction. That's where we are right now. And as we go from the last stage to the beginning stage of the economic cycle, of the business cycle, we're going then into a time in which bonds outperform stocks. So the TLT will outperform the SPY. We're just not there yet. So with the TLT, you can see it here. It has been on a mighty decline since August. Let me update this here real quick. This is not the updated, I don't think, weekly expected move for TLT. But look at this. I mean, it has been in a monster decline. Monster decline. And there's its top right there. In 2020, we got May 2020 and a double top August of 2020. The TLT is not going to turn around until we get into the beginning stage of the economic cycle, and that could take another 6 months. So I would go long TLT once that bottom is secured, because it will outperform stocks. So that's just a quick take there on TLT. There's not really much to say. Bonds are going to perform bad. They typically do at the end of an economic cycle. And then they typically perform really well at the beginning. So you can see this going back to 2015, right? The 2020 run up, the double top there, and then it's just been a strong sell-off ever since. And I would suspect that sell-off continues for TLT until we get to the very, very beginning of the economic cycle, and we're just not there yet. And like I said, it could take 6 months. And then JP Morgan, earlier I said I'm looking to short banks. JP Morgan's one of them. But I think I would do it not on an individual level. I think I would do it on a more broad-based, like going into the financials specifically sector. JP Morgan, I mean, look at this hump right here. It's back now. I mean, we can just look over here to the left-hand side. This thing tagged August, September, October of 2020 lows. And if we go back to looking for this particular line that it's on right here, that it bounced off of right there, that's a very busy line right there. And it's, what is that about? $105 a share. Very busy position there for JP Morgan. But anyways, JP Morgan went on a bit of a run here because of earnings, and specifically because of earnings. But JP Morgan, it's one of the better big banks, but banks don't like inverted yield curves. And I mean, look at this thing. We can go back to June, May, and look at this. This thing is basically gone nowhere. It's been trading sideways. That's because banks do not like, and they do not perform well when there is an inverted yield curve. We've had an inverted yield curve for months. JP Morgan has gone nowhere for months. Okay? I don't think they're going to continue going anywhere. All right? They could continue to go down, especially if we hit today, the 3-month and 10-year finally inverted today. It inverted by 3 basis points. That's enough. That's a Fed staple. So that shows what Jamie Dimon was talking about when he mentioned a recession is coming. So I don't have confidence in going long banks right now. I would rather short banks, but I'm looking for the right setup, okay? I don't want to get in too early and have my capital eat it away. I want to get in at a good point. I don't know if we're quite there yet. But JPM, it did spike there because of earnings, but they're predicting 2023 is not going to be a good year. Inverted yield curve, the 3-month, 10-year inverted today, and we're setting up for a recipe that is not a good environment for banks. How do banks make their money? By lending money. What is the Fed trying to do right now? Limit people from borrowing money by raising rates. The higher rates go, the tighter the lending restrictions will be, the less banks will be able to lend out. The banks will be lending out far less money and making far less money. Inverted yield curve also then means that banks have margin pressure. So, just my quick thought there on JPM. I'm not excited about the future of banks right at this moment in time. I think there can be some downside for them. I'm looking for a shorting opportunity for the financial sector. And TLT, same thing there. Now is not the time. It needs to find its bottom, and we need to go from the end of the economic cycle to the beginning of the economic cycle where then at that moment in time, bonds will start to outperform and move in the right direction. Okay, so a couple good things there. Financials, just be cautious, be on the lookout. Look for, I believe, and again, not financial advice, shorting opportunity for banks and for the financial sector. Bonds should start performing well once we are out of the end and we are firmly in the beginning of the economic cycle. So just some couple things to talk about. Tesla reports its earnings tomorrow. Netflix, NFLX is the ticker. I saw an article title before going live saying Netflix is back, right? Because Netflix had awesome earnings report after the in the after hours, after the market closed today. So that brought a lot of other, like Paramount, Disney Plus, those stocks up with it. But it's because we're going into the winter time, right? What do people do in the winter time? They spend less time out and about, more time watching television. That's why all the major networks release their new seasons, right, during this time. So it's just, to me, it seems like a common sense for Netflix to start doing better right now. So keep an eye out for Netflix. It could continue to do well as we go through the winter months. All right. Any other questions that you all may have? Plug them in now, or we can wrap this thing up until tomorrow. And I will be back tomorrow after the market closes. Are you getting into any earnings coming up? If so, which stocks? Nothing yet. Nothing yet. I will play some earnings potentially this earnings season, but I'm not doing any this week. I'll let you know. As a matter of fact, I'll make a note of that to let you know of any earnings that I am gonna play. Especially, I'll send a note out first on Patreon, Discord, and then go from there and share on here live. So earnings plays. Okay. Anything else? All right. Well, just be on the lookout for the SPY, the Qs tomorrow. They really have got to break out, and again, use that island from October 4th, 5th, and 6th. Use those highs right there as the highs that the SPYs, the Qs, the IWMs, they need to break those highs in order for this rally to continue. Otherwise, also watch for the fact that we are above, like right here for the SPX, we are above the weekly expected move, and 68% of the time, the options market gets it right that by the end of the week, by the close of Friday, price action is within those two lines, somewhere within there. Right now, we're out. So it could be a potential setup here for a shorting opportunity back into the weekly expected move by Friday. So don't leave that potential play just out there hanging. If we get some strong rejection at the highs made on October 4th, 5th, and 6th, then we could have a pretty good opportunity to short as the market goes back into the weekly expected move. So keep that on your radar as well. And that'll work for SPX, the SPY, the Qs, the IWM, even the DIA. Okay. So watch out for those potential moves and where we need to go. 380 on the SPY, we need to break that if we want the rally to continue. 3,800, I'm sorry. Yeah, I said that right. 3,800, we need to break that if you want this rally to continue, okay? That's for the SPY and the SPX. So watch that number carefully. If we get a breakdown from that, then watch for a shorting opportunity back into the weekly expected move, which is 36.97 for the SPX, and I believe it's around 369 for the SPY, or 397. Let me go to the SPY to make sure. Let's see what that number is. And it is, a drum roll please, 369. Okay, good. 369 for the SPY. All right. Well, if everyone is good to go, we'll wrap this up, and I'll see you tomorrow after the market closes to talk about what happened, why it happened, and what to expect going forward. And if you like the perspective, click the first link in the description and join our private investor community. I think you'll like it. And click the like button, subscribe if you haven't, and share this video with a friend. That is incredibly helpful, and it only takes a moment to do. Okay, ladies and gentlemen, thank you so very much for joining me today. You are absolutely welcome. I will see you in the next video. Take care.